Hello and welcome to another video of this course. In this lesson, we'll be looking at the methods of financial accounting, and under that, we'll be looking at the accrual basis method versus the cash basis method. We'll also be looking at the differences between accrual and cash basis accounting. We'll be looking at the GAAP versus the IFRS method. We'll be looking at their differences as well. We'll be looking at financial accounting versus managerial accounting and professional designations for financial accounting. So starting with methods of financial accounting, primarily there are two methods of financial accounting, which are the accrual accounting and cash basis accounting. So now let's look at the accrual accounting. Accrual accounting is a method that records revenue when it is earned, meaning that when a product or service has been delivered to a customer and there is a reasonable expectation of payment. This approach follows the principle that financial events should be recorded in the year or period in which they occur, regardless of when payment is received. And that is the distinguishing factor. Recorded or financial events should be recorded and recognized when they occur, regardless of when the payment is received. In this system, revenue is not dependent on the timing of cash transactions. It is not dependent on when payment is made or payment is received. Instead, it is recorded once the earning process is complete and the business has fulfilled its obligation to the customer. This method is especially important for companies that provide goods or services on credit or have long-term contracts, as it ensures that income is matched with the time period in which it was actually earned. And also, expenses are recorded when they are incurred, not when they are paid. If a business receives goods or services in a given period, the associated expense is recognized during that same period, even if the company does not make the payment right away. This matching of expenses with revenues is at the heart of accrual accounting. So, what is cash basis accounting? In cash basis accounting, revenue is recorded only when cash is actually received. Note this, revenue is only recorded when cash is actually received. A business recognizes income at the moment payment is collected, regardless of when the product or service was delivered. This approach is an easier way to track money coming into the business and provides no discrepancies between the amount of revenue earned and the amount of cash received. Expenses are recorded only when they are paid, not when they are incurred. This means that a bill does not show in financial records until a payment has been made. So this is an example, right? If a company receives an invoice for services in January but does not pay the bill until February, the expense will show up in February and not January. This method is often favored for its simplicity and ease of use, especially by small businesses and individuals managing personal finances. It requires minimal tracking of accounts receivable or payable and focuses solely on transactions that affect the actual cash balance. It also follows the logic that revenue is not truly earned until you receive the actual cash from the sale, regardless of what a customer actually owes you. So, having had an understanding of the cash basis and accrual basis accounting, let us go deeper and know their key differences to further help our understanding. So the first aspect you want to look at in the differences between accrual and cash basis accounting is the timing of the revenue or expense recognition. In cash basis accounting, revenue is recognized only when cash is physically received. Accrual accounting recognizes revenue at the point it is earned, typically when a product is delivered or a service is performed, regardless of when payment is made. Similarly, expenses under the cash method are recorded only when the payment is actually made, whereas in accrual accounting, records are made when they have been incurred. The next aspect is in their complexity. Cash basis accounting is simpler and easier to implement. It does not require complex accounting systems or extensive record keeping. Accrual accounting is more intricate. It requires more robust systems to track its items owed to others or owed to you. Another aspect is its adherence to the matching principle. Accrual accounting adheres to the matching principle, which requires that expenses be matched with the revenues they help generate in the same reporting period. This produces a more accurate depiction of financial performance. Cash accounting does not follow this principle. So, having understood that, we'll be looking at the GAAP versus the IFRS methods. Now, as previously mentioned in the first video, GAAP stands for Generally Accepted Accounting Principles, which are the generally accepted standards for financial reporting in the United States and in most countries all over the world. The IFRS stands for International Financial Reporting Standards, which are a set of internationally accepted accounting standards used by most of the world's countries. So the GAAP is mostly accepted in the US, and then for the IFRS, which is International Financial Reporting Standards, is used by most countries all around the world. And their key differences are that the GAAP is a framework based on legal authority, while IFRS is based on a principles-based approach. GAAP is more detailed and prescriptive, while IFRS is more high level and flexible. GAAP requires more disclosures, while IFRS requires fewer disclosures. GAAP is more focused on historical cost of assets, while IFRS allows for more flexibility in the valuation of assets. And now I know that someone is wondering, why is IFRS not used in the US? Why is it only used in most other countries of the world and not accepted in the US? This is why. The IFRS is not used in the US because the US government has not adopted it as the official accounting standard. So instead, the US uses its own set of generally accepted accounting principles. That means the US has its own principles that are generally accepted in the US. The US government has indicated it as considering adopting IFRS, but is still yet to do so. What are the differences between a GAAP and IFRS inventory? GAAP and IFRS have some different requirements when it comes to inventory. Under GAAP, inventory must be valued at the lower of cost or market value, while IFRS requires inventory to be valued at the lower cost or net realizable value. GAAP requires inventory be valued using a specific cost flow assumption such as FIFO or LIFO. We will learn about that in the next videos, while IFRS does not have such requirements. Now we'll be looking at financial accounting versus managerial accounting. And the key differences between financial and managerial accounting is that financial accounting provides information to external parties, while managerial accounting helps managers within the organization make decisions. And the next thing we'll be looking at is professional designations for financial accounting. These are the various professionals that you can find in the accounting profession. We have certified public accountant, we have the chartered accountant, we have the certified management accountant, we have certified internal auditors, and all their responsibilities have been listed in the course outline or in the lesson notes. Thank you so much for watching. In the next module, we'll be learning about transactions, recording transactions, and the different methods of recording transactions.